Yes.
Good afternoon, everybody, and welcome to this edition of our webinar at the CFO Board. We have just seen quite a milestone policy announcement by the Finance Minister, and the objective of this gathering and this conversation is to get the perspective of leading tax expert, leading economist, and of course, senior financial leaders and CFOs. While before I request Mr. Malingam to chair the session and invite and welcome the speakers, we will be recording this and this would be updated on the website. I'll also encourage all the participants to share their views and questions on the chat box, and our speakers will, while they answer the question later in the Q&A session, they will parallelly be also responding and taking feedback from you as we go along. With this, I'd like to request Mr. Malingam to begin the session and introduce the speakers. Sir, over to you.
Thank you, Pranjal, and let me add my own welcome to everyone who is participating. And I'm particularly glad that Mr. D.K. Joshi, Chief Economist of CRISIL, and Rajiv Dimri and Vivek Gupta from KPMG are going to be making presentations today in this meeting. It was when we had the last executive committee meeting of CFO board, there was a unanimous request that we need to have something on the implications of budget soon after the announcement, not very late. And that's the reason why we have gone ahead and organized this. And we are, as the budget itself budget has essentially, as the finance minister said, two main things. One is, of course, two main themes. One is the capex spending, and the other one is what she called the Amrit Kaal, or we are now looking at the India at 100 and setting the conditions right for the economy to progress in that 25-year-old journey from India at 75. This is one of those, I was after the budget speech for a couple of days and so on, there were absolutely no negative comments. Even, of course, when I look at the opposition parties' interventions in Rajya Sabha and so on, including from Mr. Chidambaram, who has been the finance minister, I didn't really see as substantive issues being thrown up in the discussion. And therefore, either it's very simple budget that no one has found any holes in it, or it's a welcome budget as far as this moment as far as this year is concerned. Are there any hidden kind of things in this? I think that's something that I'll have to wait for other analysts to come and tell us. But from my perspective, and I sit on many boards as independent director, there has really not been very many complicated things that have been brought in the discussions and so on. As you know, some of the board meetings have also taken place, and nothing very much has really come up. But let me just, having said that it is something that has not really evoked any major kind of opposition at this moment in time. And the general feeling has been, I don't know whether it is positive or not, but certainly something which has not worried people and so on. So the main, there are some macroeconomic issues which Mr. Joshi, I'm sure, is going to be dealing with. I mean, some of the people have really talked about what kind of a growth that does the budget really assume, because the economic survey has pointed to 88.5, and the budget has taken a nominal growth rate of 11.1%, coming on top of a fairly high inflation cycle as far as this year is concerned, 2021 and 22. And therefore, what is it that is going to really be the kind of thing? The other issue that has come up, which I'm sure will also be taken up, and which has been bothering many of the companies and so on, is really in terms of whether it is going to be evenly loaded during the year, or are we going to have this capex, which is really the driver that we are all looking at, going to be back-ended, or how is it going to play out and so on. Of course, there have been explanations from the ministry saying that as far as that 100,000 crores, which is going to be disbursed to states, they expect it to be operational fairly quickly, and then the balance will be taken up, and they don't expect it to be backloaded and so on. But again, it's something that will affect all of us, because we would like to see the growth inching up as quickly as possible over this period. The other issue is really that we have had many initiatives that have really been thrown up in the last few months. PLI scheme is something that has really come in, and therefore there are incentives, there are actual initiatives that have really taken place, and taken together, what kind of expectation can we as companies in different sectors can set for us. I think that will be a very important one. Personally, some of the companies that I'm involved in and so on, PLI scheme and so on have been have been one of the focus areas for them in terms of applying and then being considered and so on. And therefore, the other issue that would be interesting is really in terms of the global scene with regard to the what is going to happen. Are there any global issues that we need to worry about? Of course, the economic survey talked about Brent being at the $70. It's much more than that at this moment in time, and therefore, and then there are other geopolitical risks that are coming in and so on. So I think there are many issues that are coming in, but the general direction seems to be a good direction in terms of this capex cycle. Of course, there are comments that have come in as to whether the capex cycle is really higher than what we had actually accomplishing in 2002, and therefore is it really growing at that? I mean, that's something I'm sure Mr. Joshi will also discuss that, or in terms of question answers that will come up. So this is a kind of scene setting that I wanted to leave with, because we have got three very eminent people who are going to take us through, and Mr. Joshi will talk for about 25 minutes or so, and then lay the ground from an economic perspective and so on. And we have two very experienced professionals from KPMG, Rajiv and Vivek. And of course, originally we had talked about this. They will make presentation on tax incentives, but I'm sure they will go beyond that and so on. So with that, I will request Mr. D.K. Joshi to start his presentation.
Thank you very much, Mr. Mahalingam, and thank you very much, CFO Board, for having me here. It's a pleasure and a privilege. So what I'll do is, as was mentioned, I'll try to give a broad macro picture also, in which I think to place the budget, and to some extent, I think what monetary policy did yesterday. So I'll try to connect the dots, so to say. And I have a presentation which I think I am trying to upload now. I hope it's visible. And
yes, it's visible.
Yeah. So let me, I think without any delay, let me just launch into the presentation straight. As far as the global economy is concerned, it's now beginning to slow. I think that's becoming very evident. Even my parent company, Standard & Poor's, forecasts world GDP growth to slow down from 5.7 that we saw in 2021 to 4.2 in 22, which is now currently, these are calendar years 22, and the other forecasts by IMF, World Bank, etc., they are all veering around this. So clearly the reason why the growth is slowing, one is very obvious, that the stimulus is now being withdrawn. So the pent up demand effect that many countries felt because of huge stimulus, I think that's coming down. The other reason is China. China is the world's largest country in PPP terms, and China is expected to slow down from close to 8% in 21 to a little below 5% in 22 because of its own factors. And I think incidentally, China is the only large country which is cutting interest rates right now to stem its slowing growth. And then, so that's a very broad picture of what's happening globally. And obviously, the growth is also not uniformly distributed. Countries which have been able to vaccinate effectively, I think they are doing much better. And those which are still exposed are very cautious. The second point I wanted to make was, as a backdrop, is that the Omicron, which we saw recently, I think is a reminder that COVID is not defeated. The good thing is that the subsequent strains of viruses are weaker, but we should also remember that there are about 50 countries in the world which have vaccination below 6% of the population, and they can be fertile grounds for newer variants. So I think fingers crossed on how this plays out. Hopefully, we are entering into an endemic stage. In this, our forecast for GDP is 7.8% for the next fiscal year, which is 22-23. This is incidentally exactly the same as what RBI had forecast yesterday. Obviously the key assumption behind it is that the virus is now entering into an endemic stage, and it will allow broad basing of economic activities. These sectors like which require contact, so to say, they are still about 9 to 10% below what they were in 2019-20. So they will start bouncing back if COVID is under control. And then hope that government investment will also support growth. The policy is turning in a way. I mean, before the monetary policy was announced yesterday, I thought that monetary policy will now begin to tighten here, but that did not happen. But it's only a matter of time. I think the central bank will have to take cognizance of various factors. The only situation in which the central bank can remain easy for longer is that the inflation in India becomes completely decoupled from what's happening globally. It's not impacted by crude prices. It's not impacted by commodity prices, and the pass through from companies to end consumer doesn't happen. So there are many assumptions behind assuming that inflation will materially come down. It can come down, but we don't know as yet. So fiscal policy took the mantle of supporting the economy, and we are today going to talk about that. And also, I think there is a general overlying assumption behind what I'm going to scenario that I'm going to paint is that the risk is now seems to be shifting away from Omicron or COVID-19 towards, I think, other risks, I mean, which have their own ramifications: crude oil, geopolitical, and US Federal Reserve's a very, very hawkish policy stance. So I think this is quickly on the COVID-19. I think just to highlight the fact that even if we get another wave, it's not likely to damage the economy too much. And we can see the mobility in the three waves. I think the mobility had fallen by close to 90% in the first wave. It fell by 70% in the second wave, and in the third wave, it fell only 15%. So I think clearly it's a indicator that the COVID-19 people are learning to live with the virus, if I may put it that way. Now, coming to the economy, when the budget was being presented, before that, the economic data was released, and that gave a picture of the economy which I have in front of you. I think the GDP is measured from demand side as well as from the supply side. If we focus on the demand side, I think most of the components of aggregate demand are now above the pre-pandemic levels, except private consumption, which is about 55% of overall GDP. And this is still below the pre-pandemic levels. And from the supply side, the trade, hotels, hospitality, all those segments bunched together, I think they are still about 8.2% below 2019-20 levels. So I think there was a hope that the budget will try to will do something about these segments as well, propping up consumption and via support to the vulnerable segments, and also by doing something for the segments which are repeatedly hit by the pandemic. Now, so the issue was, as I mentioned, was I think one, that you need to support the vulnerable parts of the economy. The second issue was that government did not want to lose sight of the medium to long-term growth potential. So the way I take the budget is that they think that things are it assumes that things are normalizing now. So we need to get back to the pre-pandemic level of spends, particularly on the revenue side. And we need to reduce that spending and spend it, reshuffle it towards capital expenditure, if I may say. So that's the broad message that the budget was trying to portray. And the rationale to me seems like, well, if growth goes up, everybody, all boats will be lifted, which essentially means that we need to focus on growing the size of the cake right now. So how does budget, every budget is if you look at the commentary, everyone says it's a tight balancing act. Every budget is a tight balancing act because there are limited resources. There's nothing new about it. And this one was particularly different because we are coming off a pandemic. So what the budget does is it does two things to create the space for spending. One is that, okay, we will delay the fiscal consolidation path. So we'll not reduce the fiscal deficit very quickly. The brown colored line that you see here is the target which we eventually want to achieve, but have never achieved. Maybe once or twice in last 2-3 decades, which is fiscal deficit at 3% of GDP. Well, we were approaching that, I think, before the pandemic, but the pandemic actually pushed the fiscal deficit up to one of the highest as far as the share in GDP is concerned. And so what government decided is that that we will not come back to this 3% of fiscal deficit path anytime quickly. And I think so we are going to delay the movement towards that. So the space that you see between the blue line and the yellow line or the brown colored line is the space that the budget gets for extra spending. So this is one thing that they have done. Second, I think in terms of their spending mix, what they have done is they have brought the revenue spending as a percentage of GDP down from 12.6% to 11.2%. And they've raised the capex as a percentage of GDP from 5.8% to 6%. Now, clearly, I think, as I said earlier, the hope is that once the growth goes up, the things like consumption, things like employment, I think they'll be automatically taken care of. So that's why there was no definitive consumption push, and the spending for subsidies, for instance, I think they were cut down by 26% over the last year. Now, this doesn't mean that the subsidy bill has been completely slashed. If you compare it with the pre-pandemic level, the food subsidy bill is still about 2 lakh crores. It was in 2019-20, it was only 1 lakh crores. So I think still there is substantial spending, but compared to last year, it is getting trimmed now. So a bit of arithmetic. It's interesting to see what the dynamics of government budget are. So in 2021-22, we had budgeted fiscal deficit at 6.8% of GDP, but it came in at 6.9%. So whenever you make a budget, I think things don't play out as you expect. So what helped the government was one, very buoyant revenue collections, because the GST reform is finally beginning to bear some fruit, and the economy also got formalized, and formal sector pays more taxes. So that's why the revenue was very buoyant. So the green thing that you see first is the tax collection. Then our second is RBI also gave more money to the government as dividends than was assumed in the budget. But there were other factors which were playing against it. I mean, the divestment, the subsidy bill actually was 0.5% of GDP, higher than what they had budgeted for. And I think then Air India settlement also cost. So I think as a net of all these, the fiscal deficit slipped by about 0.1% of GDP. For this year, I think if you see from 6.9 last year, they want to bring it down to 6.4. What is helping is the pace of normalization of pandemic spends, which is bringing down the revenue spending of the government. So that is reducing the deficit by, that would have, if everything else were constant, it would have reduced the deficit by 1.3 percentage points of GDP. But since there are other offsetting factors, the nominal growth is very conservative. I think almost everybody is assuming that the growth will be faster than that. And also, I think the implicit assumption made by many experts is that as a consequence of faster growth, you will get more revenues. So there will be some extra space with the government to take care of spending on revenue side if the need arises, so to say. And then government has also become more enlightened on the revenue on the dividends from RBI, because I think every year it's not possible to get high dividends, so maybe that will be lower. And divestment also accordingly, I think going by the experience of last year, I think they have trimmed their divestment target. And they are spending, I think, so what is pushing the deficit up is also spending on roads, highways, housing, etc. So that bill has gone up. So that's one way, I think. So this is the dynamics. I mean, how are they engineering a decline in the deficit? Now coming to capex, I think this is an important theme. The budget had, if you look at, it's like 7 blind men and an elephant. Depending on what part you are holding, you draw conclusions about how much of capital spending is there. And as Mr. Mahalingam was saying, that actually what happens is that in all the conclusions that you reach on the first day of the budget, I think they get trashed gradually, because you start seeing the innards, the inside of the numbers, and that sometimes is a pleasant side, sometimes is not a pleasant side. So I think I just want to cut the chase. I want to mention that the government through the budget influences capex in 3 ways. Number one is budgetary capex, which they directly budget. Second is they also give grants for creation of physical assets, like for instance, Prime Minister's Awas Yojana, which is creation of assets, or Gramin Rojgar Yojana, which is also creation of assets. I think that money is under it's under grants. So it looks like it's a revenue spend, but I think it actually goes for creation of assets. And then I think the resources of the central public sector enterprises also go in. So what has happened is the budgetary capex has gone up. This includes 1 lakh crore transfer to the states as well for capex. The grants for creation of capital assets have gone up, but the PSUs, the central PSUs, I think their contribution to capex is going to decline by 7%. So if you sum up all these 3, you get a figure of around 14.5% growth in capex. Now, if the states are able to utilize the funds which the central government is providing them as interest-free loans for 50 years for capex, I think then you can say that overall capex will be 14.5%. If they are not able to do, then I think the reaching the targets will be difficult. So let's look at what happens. I think I also want to bring in the issue which Mr. Mahalingam had pointed out about the ability to spend uniformly during the year. So if you look at capex, I think this is the first chart that you see is on the cumulative capital expenditure beginning April to March. This is I've taken it for 3 periods: 18 to 20 fiscal year 21, and fiscal year 22. So underlying theme in all these is that by, I think, November or so, only about 50-55% of the spending is done, and rest of the spending gets bunched towards the last 4 to 5 months. What the pandemic did was it disturbed the spending pattern even more. So I think for instance, compared to the average of 2018 to 20, where I think by November, government had spent 65% of its capex. This year, I think they only managed to spend 49% of the capex, overall capex budget, which means the rest 4 months will have to take care of the rest of the budget. And I think interestingly, I think capex begins to pick up towards the last quarter. And this year also we saw that there was a very sharp increase between November and December. The cumulative capex now by the month of December was 71% of the annual budget, which essentially means that central government will be able to reach the target by the year end. But if you look at the states have been hit very hard, and the states generally are only able to achieve about 80-85% of whatever they budget in the whatever capex is budgeted. This year, I think compared to 71% utilization of funds by December, states have only utilized 43%. So they are going to fall behind. And I have no reason to believe that the next year is going to look any different. I mean, unless I think the government completely transforms its funding, its spending pattern. And by the way, the couple of years back, the government had brought forward the presentation of the budget by 1 month to ensure that the spending will get done in a uniform manner, but that did not happen. I mean, and that's not visible in the data, so to say. So somewhere, I think the planning requires to be improved. And as far as the private capex is concerned, I think we all know the large companies, I think particularly cement, etc., steel, they have the money, they are deleveraged. They are also doing some capex, but a general increase in capex is still waiting because the environment is uncertain, and companies also don't want to end up over investing on the basis of just euphoria. Now, I think the second leg is consumption, I think, which I'll spend half a minute on that. Now, the private consumption, which is still below the pre-pandemic levels, it can be influenced by budget, and budget has done very few things for that. It has given, I think, money for Narega, it has given money for PM Kisan, and it's also given some fund transfers to Awas Yojana and Gramin Rojgar Yojana. That will help, but there's no big push on the consumption side, which government also agrees. And interest rates are going to be at best neutral. I mean, if they're not supportive, if RBI raises interest rates, they'll be non-supportive of consumption. Otherwise, they can't decline from here. So what the consumption recovery is based on, or is hinges on a very broad-based recovery in the economy, which means that the contact-based services, particularly in the urban areas, etc., they recover back to their pre-pandemic levels and maybe overshoot them. I think that is going to provide some employment opportunities for people who are underemployed, etc. So it's all based on recovery in growth. I think the other things which we look at, let me focus on this chart. I think I don't want to overrun my time, so I want to stick to it. So this is, we look at, maybe I'll give a 10-second reference to this chart. So this chart is the financial conditions, which, if you noticed yesterday, the central bank governor had referred to it. Financial condition essentially means what is the overall situation with respect to the availability of funds. I mean, are the conditions tighter? Is there going to be a credit squeeze? Is there going to be a credit freeze? All those kind of things. So here, I think the index shows that if you move up, then I think the conditions are getting easier. If you move down, conditions are tighter. So during the taper tantrum, we all know what happened. The financial conditions became extremely tight. Then during, I think, when the global pandemic was declared, again, I think we saw financial conditions tighten because people become very cautious and the funds start flowing out. After that, the efforts of RBI and printing of trillions and trillions of dollars by the advanced country central banks meant that the domestic as well as the global factors together kept the financial conditions easy. We believe that they will still remain easy for some time, but they will gradually begin to tighten now. So the direction is towards tightening because that's what the Fed might do. And here I think this is a heat map. I can't go into every element. So let me just make 3 points here. What has happened in the last 3-4 months is that the corporate bonds, the AA, the spread of corporate bonds over the GSEC, I think that is rising fast, which means that there is risk perception is increasing for even for AA rated corporate debt. The second point I wanted to make from here is that the foreign capital is now flowing out. I think in terms of the portfolio investors, it is, I think, continuously since October till January, and it still continues to flow out. I think the rupee has so far not been impacted much because I think there are other forms in which the money is coming. I mean, maybe I think it is coming in the form of venture capital, etc., etc. So there are some buffers available, and RBI also has a somewhat healthy balance sheet of foreign exchange reserves. And then I think the other thing which is adverse for our markets is the crude, which averaged $85.5 a barrel in January, and now I think is above 90. So I think, so what this essentially is trying to say is that there are still a lot of green spots, I think, in the factors that drive your overall financial conditions. But at the same time, I think there are some red spots emerging, and some of them are turning from yellow to red. So these things need to be very closely monitored. And if you see more reds, then I think the financial conditions become tighter, which means it's difficult to raise money in the market. I mean, whether it is your equity market or your debt market, or even the banks become shy of lending when the financial conditions tighten. So that is, I think, needs to be watched. And in this, I think, yeah. So let me bring in the monetary policy here now. So monetary policy has a very big role in ensuring financial conditions do not tighten. And this is exactly what yesterday's policy did. So what happened when I think the market was positively surprised by central bank not touching anything, then I think that immediately led to the yields going down for the 10-year GSEC. So which means that financial conditions or perceptions about financial conditions started easing. Now, it's not that RBI is not tightening, it is tightening, but it is not formally tightening. It is tightening very quietly and by stealth. Otherwise, how could the 10-year bonds increase from 6% to 6.8%? I think that is, I mean, anybody will tell you that the 10-year bond is the risk-free rate in the system, and 10-year bond rising means that interest rates are going up, although they are not, because I think conceptually you have the risk-free rate, and every other interest rate in the economy is over the risk-free rate, depending on how much risk it carries. So I think so far my sense is that the monetary policy was very bullish on its inflation forecast, which is a very bold call that they have taken. And I hope that it turns out to be right. And then that means that financial conditions will stay easy for longer. But I think what the Fed does is we don't know, and how it impacts, we don't know. I mean, Fed is on a daily basis, I think we are getting some surprise or the other. So this time around, although India is better positioned to withstand the increase in interest rates from US, it is not immune to it. And the shock that we are getting, our vulnerability may be a little better or lower, but our shock that is coming is pretty strong. I mean, so let's, I think, keep us fingers crossed on this. And we saw, as I was mentioning, I think the yields which were already rising, they eased off a bit yesterday. How long they will stay like this? It depends. I mean, it depends on how the inflation outlook plays out and what RBI communicates, which is a very delicate communication. And so let me, I think, stop here. This is our outlook table. I think I have completed I'm completing my 25 minutes, so I want to stick to time. Here, I just want to highlight the fact that the 10-year bonds which are currently at 6.8, 6.7. I think they currently our forecast is that they will next year they will hover around 7%, unless I think the inflation outlook from the RBI changes completely, and the Fed and actually yesterday Fed even one of the Fed members even talked about between the cycle rate hike. I mean, so that is what has spooked the markets today. So there is a lot of risk that is coming from Fed stance, from geopolitical, and monsoons. We've got 6 normal monsoons. We typically never get that. So let's hope that I think this year also is a normal monsoon year. Otherwise, I think the computations of the budget and as well as RBI can go haywire. So let me stop there, sir. And I think this is my 25 minutes are also over. Thank you very much for listening in very patiently. Let me, I think, try to stop share. I hope I was audible all through.
Yeah, thank you, Mr. Joshi. I think it was, you were certainly audible, and very well-structured presentation that you had given, covering almost all the topics, including your forecast of the GDP growth, which is 7.8%. And then you have also got into the monetary policy issues that are arising, certainly focusing quite a lot on the global issues that are developing and so on. So I'm sure we'll be debating some of those as we go along. May I now request Mr. Rajiv Dimbri to come in and make his presentation?
Sure. Thank you. Thank you so much. Thank you, Vivek. So, I mean, since 2014, we've been hearing, multiple approaches. Some of them are interlinked, whether it's Achhe Din, Sabka Saath, Sabka Vishwas, Atmanirbhar Bharat, Vocal for Local, Startup India, Make in India. When we distill it in terms of what gets achieved in economic terms, in real policy terms, we're focusing on how much of this, at least in this budget, cumulatively is coming into invest in India or invest from India. That's what we are distilling, and that's what we are analyzing in this budget. So yes, we will talk about some of the taxes, but we thought we'll put it around these themes so that it does make sense rather than analyzing just pure play, changes that have been done in the tax proposals. So that's the theme that we will run through the presentation, and part of it I will take, and part of it I'll invite Vivek to come in and talk and share his perspective. So if, and Mr. Joshi did talk about some of it, is that if we were to look at pools of capital, it could come from strategic FDI, investment, and we'll see what has happened in this budget to encourage or promote that. There could be other sources of private capital, whether it's coming through equity, venture capital, private debt. And again, Mr. Joshi briefly talked about that in his presentation. It could be public markets or government spending. And we will look at what is this budget trying to achieve, tapping into these pools of capital through fiscal and tax measures that have been announced. So looking at from the FDI perspective, which is largely to say, how do you promote the manufacture in India? It may be, strategic FDI. It could be private capital as well. And this goes on, along some schemes that have been running for a period of time. Last year, the government announced that any exemption notification that will come will have a automatic shelf life of only 2 years, which is a departure from what has generally been happening. We still have live notifications that were issued in the 90s. And one of the constructive feedback that has been going to the government is we should declutter these notifications, because today it is almost an art to determine what product has what rate applicable, because there is a tariff rate, and then there are series of notifications, and sometimes on a same item there could be 2 competing notifications. And therefore, the government has done a few things to rationalize that, and also bring about that the exemption philosophy, because exemption promotes import, and in a sense, it's a detriment to the local economy. And while there is a focus on promoting manufacturing in India, automatically any and every exemption is going to have a short shelf life. And the first phase of that route, weeding out of notifications will begin from 31st of March 2023. It has also been announced that generally the exemptions on capital goods, which again was part of the policy to import capital goods, which became, adding to the capacity, those are being withdrawn, and therefore that announcement has been made. Not just generally capital goods, but there was a scheme, and there is still a scheme, of what is called project import scheme. If you're setting up a large, project or a refinery or a, power plant, then you're able to import capital goods at a lower rate of duty, even as low as 2.5%. That is being phased out effectively from September of this year, where the rates will start moving to 7.5%. So in the long run, this will benefit the manufacturing, particularly the capital good manufacturing sector in India. In the short run, it may impact those projects that were currently relying on the concession rate of duty, and therefore these projects are in the pipeline. Their capex cost may go up, and therefore it has a dual effect. But in the long run, certainly this is going to promote or create a level playing field between imported, competition as well as local production. There's also, further enhancement of this phased manufacturing program. As you all would have heard, and this has been often repeated at multiple levels, that the localization or manufacturing of mobile handset smartphones in India actually came about by creating a duty arbitrage, a customs duty arbitrage. The same thing is now being attempted for other, products like smartwatches, hearable and wearable devices, and smart meters. So this scheme has come about. I guess we will know in about a year and a half, whether that results in actual translation of those projects starting up in India, because it creates a arbitrage where finished product will attract a higher rate of duty, but if you were to bring in parts and locally assemble and manufacture, you get a duty advantage on that. It has also been plotted out that this, over a period of 4 years, this concession that has been granted will get phased out. Hopefully by then, these projects would have achieved a certain scale and efficiency, and therefore duty arbitrage is not permanently needed. And therefore that's something that the economics will drive those decisions rather than pure duty arbitrage. Mr. Joshi also referred to the PLI scheme, the production linked incentives. We are all aware that it started with 3, then 10 more got added. And now, 2 things have happened in this budget pronouncement. They've also announced for the 5G infrastructure, and the budget allocation for high efficiency solar modules have been increased significantly by close to 20,000 crores. So effectively, it's now 14 schemes of PLI for different products that are now in place. And of course, we all heard the announcement that now 68% of the defense capital expenditure will be domestically sourced. This is up by 10% from previous year. So that again will promote this defense manufacturing in India, because if there's an advantage in allocation for local manufacture, it will create that environment in the country. Last but not the least on this area is the concessional corporate tax rate, which was announced for new manufacturing entities. That was set to expire in 2023, and there was a large number of representations for the period to be extended. So they've added 1 more year. So any new manufacturing entity that is set up by 31st of March 2024 will be eligible for a concession rate of 15%. So those are all the tax-related programs to promote manufacture in India, is our takeaway from this budget. On certain other ease of doing business in India, rationalization measures, as I mentioned briefly, that the combination of high tariff and then dozens and dozens of notifications bringing down the effective rate of customs duty They've tried to simplify that and what is being called as tariffization of unconditional exemptions. That instead of having a high tariff rate and an exemption reducing the duty, all unconditional exemptions are now being baked into the tariff, which will make this whole process much more simpler. You just have one place to refer. You refer the tariff, whatever is the applicable rate of duty, that becomes, so it eases up the administration, it eases up any potential dispute. So it is certainly a rationalization measure and a much welcome measure. We also heard the announcement that the entire SEZ laws will be overhauled, and not just the law, but the whole administrative setup will be made more IT enabled. It will be perhaps an important development that will happen as and when this announcement comes. My personal sense is, and it's just my personal take on it, is that it is possible that the SEZ Acts, which are currently designed to only promote exports, may be more broad-based, partly that, there is a scale needed for an industry to be economically viable and can't just simply be export-oriented. B, there have been several attacks at the WTO level where many of the schemes and promotional schemes of the government have been found to be in violation of the WTO rules. And therefore, I believe it is a combination of this which is going to result in whichever form or shape the SEZ laws will get rationalized. But I think it will be an important development that will take place sometime during the year. On litigation and dispute management, 2 action steps. A, the taxpayers now have a right to correct, an option to correct, if they have missed out on reporting certain incomes or certain transaction, that they have the ability to file an updated return, which allows for some predetermined penalty to be paid, but it helps them close the matter without any prolonged disputes. And also a policy where a department on single point will not file repeated appeals, and therefore these 2, if implemented well, and we will know the results perhaps in a year or 2, whether that is actually bringing down litigation at the point of inception, because this is an area where there has been a long-standing demand that we need an ongoing mechanism to settle disputes rather than once in a while amnesty schemes that have come about, that why can't there be an ongoing program? And I think this updated income tax returns at least is driven out of that spirit. We also heard the announcement on accelerated corporate exits. At least, we all have experienced that the process of setting up an entity in India has, over a period of time, been simplified. It is much more simpler and faster to set up a company, but exiting a company and winding down a company is still a long, painful process. And therefore, there are some policy announcements expected later in the year. At least on the speech, we heard that the desire is to bring it down to 6 months. That would absolutely be fantastic. But any reduction or a rationalization from existing processes will be a huge improvement. We also heard other announcements like infrastructure status for data centers. Now, part of it has been done in the past, but generally recognizing that this is also an important economic activity, and attracting and promoting establishment of data centers in India is part and parcel of the digital India journey, and it does create employment, it does create an economic activity. I think that itself is a welcome move. And this battery swapping policy is a step in the right direction, which will perhaps make the environment for electric vehicles more conducive. I think it will help in speeding up the larger infrastructure, because electric vehicles can only be popular if the charging and other infrastructure in the country is developed. I think this battery swapping policy will be the step in the right direction, but it will perhaps take us a couple of years before we will know how really has it helped in popularizing the electric vehicle segment in our country. So these 2 were the slides I wanted to cover about, on the Make in India and what is being done for ease of doing business in India, which is a necessary part of the corporate India. For the remaining part of the section, I would invite Vivek to take up the presentation, please.
Well, thanks, Rajiv. Am I audible?
Yes, Vivek.
Okay, thank you. Thank you very much. So very lucid exposition, first of all, by Mr. Joshi on the overall economic scenario and some of the signals from the budget. Mr. Mahalingam, you started off by saying that this is a very simple budget in some sense, and that no one could find anything wrong with it. What I hope to cover in the next 10 or 15, 10 minutes maybe, is what are the signals that we read from this budget in terms of the direction that it is setting out in terms of other forms of capital. So Rajiv spoke about the strategic FDI bit, what multinationals looking to invest in India can look forward to, and how does the budget signal let's say, a more generous regime towards them. I will cover some of the other forms of capital and some of the steps that this government has taken, which leads us to call this budget an Invest in India budget. I'm not going to talk about the very obvious things. I would want this group to appreciate the signals that we read from this budget and why we believe that the government is about to take a global competitiveness leap in terms of attracting these other forms of capital. Mr. Joshi said the monetary space for expanding investments is now limited. Even globally, we are hearing Fed tightening. He spoke about mid-cycle rate hikes, etc., etc. So this whole COVID-induced liquidity, it will, over time, start getting, let's say, tighter and tighter over the next 2-3 years. And I think the government very smartly has recognized that. One of the major sources of capital for the economy is the entire private equity and venture capital universe. And on the private equity venture capital side, I think the government has very strongly shown us the direction of where it wants to go. So just to give you a context, historical context, 4 to 5 years ago, the private equity and venture capital flows in this country to us were about $15 billion. So we were able to invite funds to the tune of about 15 to 20 maximum $billion in the last 4 or 5 years. This year, the last year that's just gone by, is the first year when we have actually broken the 60 billion range in terms of attracting private equity and venture capital investment. Now that is a quantum leap. That is a 4 times leap. It doesn't happen in any country. It's not happened in any country in the world that you have 41 unicorns come up in 1 calendar year. What the government is indicating is, and if we speak to the government, they may not have budgeted for it. But what the government is indicating is that we want our private equity venture capital flows to top a century going forward. So they want to create a regime where effectively our normal 15 billion kind of number, our abnormal COVID-induced 60 to 70 billion kind of number becomes a new normal 100 billion plus kind of number on the private equity venture capital side. That's the impulse that the government wants to give. And that is why in this budget, they've come up with 3 or 4 very important themes. First of all, and this has been a demand from the private equity venture capital side, and I have personally been in many conversations with the government on this. They've agreed to set up an expert committee addressing the issues of the private equity venture capital industry frontally. We expect in the next 30 days, this committee will be formed. We expect that this committee will then come out with a report within the next 90 days of that. So in the next 4 to 5 months, we expect a report in terms of what can be done to the private equity venture capital industry. I think this is the impulse to say, how can the abnormal 60 billion become more like a normal 100 billion? So that's point 1. Point 2, the government is itself open to anchoring, sponsoring, whatever best word that you use, thematic funds in sunrise sectors. It's very easy to get private equity and venture capital in areas where profit pools are very clearly evident. But there are sunrise sectors where profit pools are dependent on government relationships and government contracts. There are areas where profit pools are not quite so evident. So what the government is saying is, we are happy to sponsor, take part in thematic funds in certain sunrise sectors because we believe that those sectors could be differentiators. Those sectors could help India leap forward: digital economy, pharma, agri-tech. These are sectors where we don't have competitive disadvantage qua the world, And therefore, if we were to be able to infuse them with the right kind of capital, we will be able to take the economy along, and we will be the developed world insofar as these sectors are concerned. We will no longer be the emerging country like we are for the economy as a whole. The third big push to private equity venture capital impetus on the gift city or the IFSC. This is where we coined the term invest from India. So if one looks very carefully at the changes that are being made to the IFSC framework, and if you sort of rewind 2 years and then see gradually how those changes have been made, there is already conversation of the fact that India, like Singapore, like Mauritius, like Netherlands, should become a worldwide hub for becoming and aggregating pools of capital. How do they do this? A very benign tax regime for financial services businesses set up in the IFSC. Not all of it has been done. This is all work in progress, but that's the directional sense that this budget provides. This, combined with the expert committee for PEVC industry, makes it absolutely crystal clear that in terms of the direction on the gift city, I would not be surprised to see the same kind of benign regime that extends to private equity and venture capital funds in, for example, Singapore or Netherlands. There are concepts like 13x, 13R, very supportive government mechanisms. Those mechanisms could come into gift city as well. So make the gift city a global hub of the Indian financial services sector. So not only are you investing in India, but you're also investing from India. And that then becomes a whole virtuous cycle of the Indian brand image, of impacts insofar as the larger economy is concerned, the degree of trust and confidence that other nations get into investing in India, and so on. So it has knock-on effects on other forms of capital as well, whether it's debt, whether it's strategic FDI capital, which Rajiv spoke about, etc. So that's the third point. The fourth point, I think IBC has been one of the most defining. So if I were to say from 2014 to now, what have been the 2 or 3 defining reforms on the economic side? I would call out GST and I would call out IBC. So buoyed by the success of IBC, I think the government is also open to now in considering mechanisms which were earlier thought of as a little bit risky. So they came in with this very tight 180-day resolution window and so on and so forth. NCLT, NCLAT, Supreme Courts helped interpret that entire IBC code. I expect to see changes in this IBC code, which will facilitate cross-border resolution, which will make this even more effective. And if our IBC starts looking more and more like the Chapter 10 in the US, that again attracts a whole new class of funds in India. So these 4 themes are meant for one objective. How does the 15 billion normal, the 60 billion abnormal COVID-induced number become 100 billion plus as an economy going forward? And then this 100 billion plus actually is expected to create a virtuous cycle of spending. Each of the unicorns that we've seen in the last 1 year creates a virtuous cycle of spending and consumption in the economy, which then takes the economy up manifold. So this is insofar as private equity venture capital is concerned. Very quickly going to private debt and public markets. 3 or 4 signals. Clearly, bond market is to be strengthened. I think the government continues with the exemptions available for FDI bond interests and so on and so forth. FPI bond interests and so on and so forth. The fact that the government has not tinkered with any of that means that the government is committed to a very active bond market. Number 2, FPI VRR investments. And let me explain what this is. VRR is a route that was opened up in 2020, wherein you could where foreigners could infuse debt into Indian businesses without having to comply necessarily with the whole restrictive mass of regulations that applied to the traditional ECBs. So those CFOs in this group who have raised monies through ECBs know LIBOR plus so much, end-use restrictions, monitoring in a separate bank account, all of those series of restrictions. May 2020, the government came out with this whole, what they call the VRR, Foreign Portfolio Investor VRR route, and they opened that up. The government was not quite clear. as to what will be the impact of this on foreign exchange rate, what will be the impact of this on our national debt, how much India will be, let's say, in debt to foreign debt, and therefore to control it, the government put caps on it. I still remember the first cap, I think, was 45,000, increased to 75,000, and so on and so forth. Today, or yesterday or day before, the government opened up this cap to 2.5 lakh crore. So the FPI VRR investments or FPI VRR lending route is a very important lending route. It's a longer term lending route than just normal bond market kind of offerings. It's a route which requires money to be in India for 3 years, but it allows corporates to raise foreign debt from registered FPI vehicles in a very cost-effective manner. Again, infusing private debt, getting in the class of private debt into the Indian economy. The third one is something where actually I think a little more could have been done. And the 70 billion, which has gone to 100 billion, the debt market, which is going up, I think there's a $30-35 billion pool of capital available for India as hybrid capital. And let me explain what I mean by hybrid capital. Hybrid capital is mezz debt, which means it is debt to the extent that the principal is protected, but it is equity to the extent that it can enjoy equity returns. Today, foreign investors are permitted to come in as equity, in which case they take entire risk, entire return, or as pure debt, ECB or FPI VRR, wherein they're taking a set interest rate from the instrument. There is a whole class of hybrid capital available in the world where you say, protect my downside, I will invest in riskier investments so long as my principal is protected. But then if you get a return above a certain IRR, share that return with me. So it's a mix of debt and equity. Unfortunately, our current RBI regime does not permit it. Way back when Dr. Rajan was the governor, in one monetary policy pronouncement in writing, he said it is under active consideration of this government that this entire route for debt type protected equity will also be opened up, but that has not been opened up. This is $30-35 billion waiting to be invested. I would love for the government to open up this route and to have exciting discussions insofar as this route is concerned. The fourth thing, very important, and this speaks to the fact that there's perhaps not much to speak about in this budget, but it's part of the whole directional strategy of the government. There's no change on capital account taxes. So the 10% capital gains tax rate for foreign equity investors continues to be 10%. There was this whole clamor, and there continues to be this clamor. You would have seen that, Mr. Tarun Bajaj's statement yesterday. There was this whole clamor for parity between residents and non-residents. I, as a resident today, pay 20% capital gains tax. A non-resident investor pays 10% long-term capital gains tax on the same instrument. But I think the government understands the value of the 70 billion, the need for it to go up to 100 billion, and therefore they did something very little. They equalized the surcharge. The surcharge was brought down from 37 to 15%, effective tax rate from 28% to 24% for residents, but the non-resident rate was not touched. So no change on capital account taxes. Very quickly, we are tax people, so we must link everything to fiscal policy. And I call this slide keeping the regime going for private capital on the taxes side. So concessional tax regime extension, 15% new manufacturing businesses, Rajiv already touched it, extended 1 more year. Startup benefit extended 1 more year. Tax rate parity I already spoke about. The resident ETR reduced to 24% from 28%, although there is still no parity between residents and non-residents. AOPs, which are a very important part of investing in the India infrastructure story, because infrastructure investments sometimes happen through consortiums between large Indian corporates and foreign companies, and they find themselves efficiently taxed as an AOP. The maximum surcharge for such AOPs, where all members are corporates, has also been reduced to 15%. Why it has been reduced only for AOPs where members are corporates is they don't want individuals to start forming AOPs and then take benefit, because the individual surcharge rate still remains 37%. Dividend from foreign companies reduced to 15%. Invest in India. is the dividend from foreign companies, which had a concessional rate of 15%, that's been withdrawn. So now if dividends are upstreamed from foreign companies into India, that is still taxable at the full rate, 25% or 34% as the case may be. Again, speaking to the whole concept of invest in India. These are the numbers. These are some very quick numbers that the government expects to top in 2022. These numbers, of course, impacted by the COVID-induced worldwide liquidity, but the government's hope is that budgets like this will cause more unicorns to occur, will cause more FDI, strategic FDI investment. So I spoke about the 70 billion private equity number. There's the 82 billion number here. There's the 42 companies who became unicorns, raising $38 billion. In terms of thematic misses, hybrid capital is something I already spoke about. Tax parity on exits I spoke about. I think the two parts which the government deliberately missed, I don't call this a non-deliberate miss. Direct overseas listing, cross-border mergers and SPACs. We were in the camp which said direct overseas listing could get in another $10 to $15 billion. So your 70 could become 70 plus 35 of hybrid, 10 to 15 of direct overseas listing, cross-border mergers and SPACs. But I think the government's taken the call that we don't want our Indian companies to necessarily go out on foreign exchanges. Hugely debated, announced once by Anurag Thakur and Nirmala Sitharaman just when COVID happened, announced the second time by Tarun Bajaj 5 months ago in a press conference in Bombay, but I think still hugely debated within the government and therefore kept for a later date for now. So with that, I can see Pranjal getting very upset. Maybe I have overshot my time, but with that, I'll call it a quick close and happy to answer questions.
Thanks, Rajiv and Vivek, for the presentation. There are some questions that have really come up in the chat, mainly from Shankar Raman. I don't know, although Mr. Joshi has responded to that, but I would still like to see if Shankar can ask the questions themselves, developing a little more, because I think these are important points. Is it possible, Pranjal, to get Shankar?
Yes, I think we're just doing that. Meanwhile, all the board members, there's some other board members, they are, coming in as panelists. Meanwhile, Sonal, if you have a thought, Mr. Malingam, you want to have a quick query? Before...
Yeah. Sonal also raised a question. So would you like to ask first?
Yes, I think Mr. Dharma, Kirti answered my first question that the government just wants to be overcautious, really. I'll go to my second questions, really. When we look at the source of capital, the revenue collection of government, and, time again, we have spoken about the personal income tax, where the taxpayers are so few and each budget, they're not able to give any concessions. And, there is a clamor that something should be done for this group. But what we see is that there's a very large number in personal income tax, which obviously the government cannot give away. But however, this number has been stagnating. This collection has been stagnating, whereas the other collections are sort of going up, mainly the GST. What could be the long-term strategy of taxing this group for the government, and what should they really do? Because you just can't go on imposing more taxes on them without really broadening the capital, the taxpayer base.
Whom are you asking, Sonal? Who would you?
Anyone, Mr. Kirti can answer. No.
Yeah, maybe if taxation experts want to take it up, I have my own little 2 cents on it. I'll come later.
I can share my perspective, but I'm sure there are other perspectives as well. In one of the interviews, the chairman CBDT announced that if you analyze the total return file on individual tax, 92% of the people have filed return where the income is below 10 lakh rupees, and only 31,000 people have filed return declaring income above 5 crore rupees. And therefore, because they don't want to, it's a very precarious balance, and they're very scared to tinker with this. In the long run, I think it's the triangulation of information, because today the government has the machinery through the GST, the council, and all other forms of data collation, that they can triangulate almost every transaction whether on your credit card, through the purchase, through the sale. And therefore, it is more with the better compliance, and voluntary reporting is where they expect the numbers to go up, because they've tried the compulsory filing schemes, more and more people to file return. That hasn't really helped. So it is the better data tracking is what their long-term objective is. And therefore, you see a whole lot of focus that is going on in not just collecting data, but exchanging data. So the data between various agencies of the government, whether it is the remittance through RBI, whether it is GST collection, whether it is all the expenditure side, that collection and sort of triangulating that information is their hope for better compliance.
I think Shankar has a question. Shankar? Sorry, DK, you wanted to take this and then we'll go to Shankar.
Just one, I think one bit. See, I think this issue has been confusing me, because when we were students, we were taught in economics that the indirect taxes are distortionary. We should have less and less of them, and direct taxes are egalitarian, and they don't distort the production structure. Now, I think if I use that same lens to look at what is happening right now, it's going the other way around. I think the tendency is now to focus more on indirect taxes as sources of revenue rather than direct taxes. I think that at least the results are showing that. Although I think I agree with Mr. Dimri that you have a good hold on people's transactions. I think maybe you will be able to increment that a little bit. But overall, I think my sense is in the next 2-3 years, we'll see more collections from indirect taxes, or faster collections than from direct taxes, which may not be very egalitarian, but but there's no, I think, debate on this issue. I think neither government clarifies. But I've spoken to a few income tax officials, etc., senior officials. I think they say that this theory has turned on its head now. I mean, so this direct versus indirect, you forget about it now. That is past. Sorry, I think that's just what I wanted to.
Just one sentence from me. So Sonu, this is a great observation. But the fact is, the small pool of IT pairs will continue until we constitutionally have one large section of our economy out of the income tax net, right? So it is by definition that small pool will continue. Unless we make a constitutional amendment to include agriculturists in the list of taxpayers. That having been said, I think broadening the tax base, increasing compliance, reducing rates and therefore increasing compliance, as well as if you see the last 3 to 4 years, the degree of intelligence that the department has about all your transactions is a revelation. I mean, I opened up my income tax portal, and the fact that they knew exactly how much I had invested through the year, and I myself didn't know, is an indicator of the fact that someone's watching. I hope that will encourage compliance, and I therefore hope this distortion of the burden coming in a small pool will get diluted.
Thank you. Shankar, over to you.
Yeah. Good afternoon, Mr. Joshi. Thank you for that excellent presentation. I just had a doubt in my mind. We are saying that it is going to take a while for domestic demand to pick up. And in the meanwhile, the strategy that most of the organizations have been following, even economy has been following, is to grow through exports. Now, if you're going to predict slowing global economy and reasonably stable rupee, if not a strong rupee, isn't that going to be a challenge to this export strategy in the next couple of years?
I think exports, there are two ways to grow exports. One is, I think there is price competitiveness, which can partly come from exchange rate. There is non-price competitiveness, that you have better infrastructure, you reduce the transaction cost, you make it more efficient to export. You reduce so I think those are the two broad areas in which people focus on. My experience with dealing with export data and analyzing it over the last couple of years has been that every time there is a global boom, our exports pick up. 2003 to 2008, our exports were growing at 25% per annum. After the global financial crisis, when the global economy lifted, they were again growing very fast. Actually, they were growing so fast that the Commerce Ministry was tempted to bring in a target of 500 billion merchandise exports by 2014 or 15, which, I mean, we still not reached that. I mean, this is several years. So what happens is that our exports have high elasticity with respect to global demand. So if there is a boom, they pick up, then they fall silent. I mean, for 5-6 years, nothing happened on export front. And during the pandemic, they have again picked up. So my sense is that they will get some kick from the PLI related because that's an incentive specifically for some segments. But a general broad-based growth in exports, I think will not sustain when the global economy slows down. And I think we do not have the bandwidth to keep the rupee weaker, I mean, so to say. RBI doesn't have that policy anymore. As a result, my sense is that meeting the target, we'll meet this year's target of 400 billion. But beyond that, I have serious doubts whether we will, going by the past experience, I think that we will, in a business as usual scenario, we'll become a great export hub. There are opportunities, no doubt. I mean, the China plus one is helping some of the sectors that you mentioned. I mean, we also in ratings, I think we noted that credit profiles have improved of companies which are exporting. I mean, and part of the export demand is coming because of China plus one, because people want to diversify away. So some of the factors are very different from the past, but for an overall surge, you have to be at least more competitive than Bangladesh and Vietnam. I mean, for things like textiles, you can look at any metric, we are not.
It's interesting you said that, sir, because this PLI also, I have been trying to raise this point that we are trying to build capacity at a time when all costs, all factors of production are inflated. Commodity prices are inflated, wages are inflated, everything is inflated, and the country is expected to build capacity. And we have, from our past experience, know how difficult it is to extract any incentive from government. And production-linked incentive is going to have its own quota of audits and certifications and validations. So I think it's a long haul, but setting that aside, the fact that capacity building is being attempted at a time when inflationary pressures are at its peak will work out well only if there's going to be a significant correction to the inflation, both wage and non-wage.
Yeah, no, I agree. I mean, and the non-wage inflation, the price inflation may come down. The prices have risen very fast last year. So you may see some drop in inflation rate, but the level of prices is still very high. I mean, even for commodities, I think, and the companies haven't passed it on to the end consumer. So I think just one more layer before I close on this export. I think one of the reasons why our exports saw a lift this year was the nature of stimulus in countries like US. So they gave huge amount of stimulus. Services could not be revived. The goods demand suddenly shot up through the roof. And that actually, we are also riding that boom partly. And now when the service is returning, I think the demand will also shift from goods towards services, and services are not so export oriented. I think that factor will also play out once the global economy starts, or the US particularly starts normalizing. So there is, and I think this phenomena also reflected in inflation in US. Goods inflation is very high. Services inflation is very, very flat. I mean, even in US. So it's a very, I think you need to look at various before concluding that we are reaching 1 trillion, I think, of exports. We need to look at what was driving this right now, and not everything is sustainable. Sorry about that long.
Sorry, even
But
then,
Supranjal, just one thing. The only hope that I have is, with technology changing a little bit, our IT services exports could perhaps compensate a little bit. So if one were to see guidance coming from all our big IT players, TCS, Infosys, everyone, they assume fairly liberal levels of growth. So that's the only silver lining on the export front, I would say.
No, that's true. I completely agree with that. I think that has defied various obstacles time and again. And again, this time also it is, fortunately, IT is so much in demand right now. I mean, it's impossible to get an IT person for the company.
Hemant is here, and so is Shugato, in case you have a question. And yes, there's also a question on import in the Q&A box, DK, in case you'd like to answer on the imports. So Hemant or Shugato, I don't know.
Yeah, I have a question as a follow-up question from Mr. Joshi. Mr. Joshi, you mentioned that, and rightly so, that possibly exports will taper a little. We have been riding on the demand, the goods exports, that is. And once that happens, and what is also, we are also seeing the pressures on oil imports and consequently inflation, and with the widening spread between the rupee and dollar interest rates possibly, which is going to happen during the course of the year, how do you see the dollar rupee playing out?
That's one of the toughest things to forecast, particularly when the monetary policies are switching and switching in a big way. I think say that, as I think was pointed out by Mr. Gupta also, I think there are other sources of capital. It's not just the trade transactions. I mean, the rupee value is impacted by the overall capital inflow. I mean, because if you see what has happened in the last 4 months, the money has flown out of equity markets, I think quite a bit. Typically, if that had happened in a normal year, rupee would have sunk. I think there are offsetting factors coming from other sources of capital globally, and which is somewhat supporting the rupee. How much they will, I really don't know, but I do see a shock coming to the rupee sometimes, I think this year for sure. It may not be as harsh as what we saw during taper tantrum, but it is bound to happen, because Fed is now in a territory where it could actually the central banks in US and other advanced countries are known to create recessions. I mean, with their monetary policy, so they may actually be very hard on the monetary policy front. That's a possibility, because inflation is proving to be pretty persistent, not transitory. So as a consequence, I think the rupee will. One thing I can definitely predict is that it will remain volatile. If you ask me my forecast, I think right now we have, I mean, our current forecast, which we have maintained through the year, is rupee to dollar at 75 by March 2022. So it is somewhere hovering around that. But for next year, I think I don't have the knowledge and ability to project. But I would say that I would go with a broader trend level of forecast, which is I think 2.5% to 3% average depreciation. Within that, a huge volatility thrown in.
Thank you.
I hope, but that doesn't help you much, because it's not. That's the best I can do.
Yeah, we saw, as in Vivek's presentation, how the capital inflow is increasing. And he talked about how it was $15 billion, and now it's about 60, and we are aiming to touch 100, etc. And this is all very exciting and very interesting. Now, what I'm kind of thinking about is, how should we think about it as impacting overall output and demand? Because you see, what we want, across sectors, is for demand to grow, output to grow, so that that investment cycle kind of sustains. And one of the reasons, as you well know, why private capital investment is kind of somewhat held back is because you want to see a sustaining increase in demand. Right now, we're in a situation where demand is coming back from the pre-COVID to the situation that we are in. Demand is coming back to kind of pre-COVID levels, and we are happy about it. But how should we think about this, that with all this capital inflow coming in through private equity, through VC, through anything else, what is the connection that we should expect in demand going up? And when we project demand, how should we think about it?
Mr. Joshi, would you like to take a first shot?
Yeah, sure. I think what this will definitely be good for certain parts of the economy. The K-shape recovery or K-shape economy that people are talking about, which is richer getting richer and poorer getting poorer. So this will actually make the K more vibrant, I mean, so to say. It's not instantly going to flow to the, there is no trickle down from this to, this will, I think we all know, I think it's been proven enough that technology is very critical, but it does lead to what is called the winner takes all. And I think the guys who are the first ones to somebody who starts a Facebook will become a billionaire. But if I start a Facebook today, I will struggle to succeed. So I think so that kind of phenomena does play out whenever I think you have venture capital or whatever. I think I don't know much about it. Mr. Gupta can answer it well. So I would say from the revival of consumption demand from the masses, I don't think it's going to play a big role there. I mean, but it is going to make the economy more stable from many other angles, I mean, so to say.
Yeah. So Sugata, one good and one bad. The good is, if there's additional 40 billion of flows, that money comes into the country. If it goes into some of the new age businesses, it actually gets spent really quickly. If it goes into some of the more stable businesses, it creates capital assets in the economy and therefore the virtuous cycle around the capital asset. That's the good part. The bad part is this is wholly capitalistic, and therefore there is no means to ensure an equitable distribution of it, which is what causes more demand stimulus in the economy. So this part of the money that comes in is entirely capitalistic money, returns oriented, will make certain sections richer. There will be the trickle down impact of the investment per se, but otherwise it will enhance inequality in the economy, in a manner of speaking. The call that this government, and that's the directional call this government has taken. The call that this government has taken is, we need to go through the virtuous investment cycle. And if we can do 3 more years or 5 more years of this 100 billion plus kind of private capital investment, coupled with government capex, coupled with everything else, then hopefully we're in a position where we lift the entire nation up. But as an immediate impulse, this is a capitalistic investment.
I suppose. No, that's a fair answer, I suppose. Thank you.
Yeah.
So we are almost running out of time. There is a question in Q&A box, Mr. Joshi, if you'd like to address that in the chat itself, on imports from China, but we'll have to end now, but I'll request Mr. Mahalingam to summarize or if he has any other query left. So over to you.
Unless Shankar wants to ask the other question that he had, which is really on the commodity prices, but because that's an interesting one, because you don't want the capital increase in capital expenditure to be drained up by the increase in commodity prices, and then the whole productivity issue takes a backseat and so on. But anyway, we'll park that. But we have had an exceedingly good, interesting discussion and so on. Mr. Joshi has laid down that whole path in terms of what happens along with the monetary policy, as I said earlier, and how it is impacting. He has not given us great hopes in terms of the balance or proper spending across the year. It's going to be, in a sense, he has pointed out to the trend and so on, and he doesn't expect the trend to change substantially, which is a bit of a problem in terms of the growth being evenly distributed and so on. Both Mr. Rajiv and Vivek have really got into a great amount of details in terms of the manner of flows that are going to be coming in, the specific issues that the government has taken up, including things like SEZ and so on, and also areas such as what is happening as far as the IFSC is concerned, and with regard to the litigation and many other aspects and so on. I think this, at least to me, as I was hearing it, shows a very structured kind of path that we are taking with regard to dealing with many of the issues and so on that are taken up. We had a very interesting Q&A session as well. So I'm sure that this has been useful for the participants. Thank you very much. And as Pranjal said, this is going to be available also for viewing later. Thanks.
Thank you, sir. And thanks to our speakers, Mr. Joshi, Vivek, and Rajiv for sharing your time, and the board members for participating. Look forward to inviting you to another such conversation. Please feel free to send some suggestions and ideas to us. Have a great weekend. Bye-bye.
Thank you. Thank you all.
Thank you very much.
Yeah. Hello. Hello.